The average 30 CD mortgage rate hit 7% in October, the highest in 20 years. This can make homeownership seem definitely elusive and horrendously costly. We look at historic rates, ladies and gentlemen, they're still low. And in my opinion, in my heart and head, if rates were 10% for the last 10 years, we wouldn't be in this problem we're in now. So the average 30-year mortgage rate hit 7% last week, the highest it's been since 2002. That pushed the average monthly payment to buy a new home up to $2,760 and just in September from just roughly $1,561 a year ago. If you look at the calculations, the mortgage calculators. So 2008 all over again. Interest rates go up, and now guess what? Banks are trying to get creative to squeeze even more money out of you, in my opinion. Think subprime in 2008, cries all over again, baby. So what is exactly going on? Some companies are getting ready to provide hunks of cash to home buyers who don't mind giving up something in return. What do you think you're going to have to give up? Your home equity, people, your home equity. That is right, a piece of your future home equity. Home buyers battling high mortgage rates could soon have a new option. You want to get in so bad. Sell a stake in their future home for as much as $250K toward that down payment, folks. You know what, ladies and gentlemen? Don't fall into this trap, people. Please. This is a trap. Please don't do this. This is the same thing as what happened in 2008, in my opinion, but with a new label. Please, in my opinion, wait to renegotiate your rate. Don't worry. We will all get through this together if you're with competent people. A loan for the down payment that you can't afford for the mortgage loan you can afford. How many loans can you take out on your home now? I guess if you can keep robbing Peter to pay Paul, then who cares how much debt you're in as long as you can make those payments, right? Until you can, and then there is a super bust and you're screwed. These investment firms and banks are doing anything to make money. And I'm smelling just a little 208 with this creative financing. This is a setup for sure. Who needs $250K for a down payment? Where do I sign up? I laughed, when I started to look at these articles that said this is to help first-time homeowners. No, it's not. It's a scam to help venture capitalists. These companies are dealing in predatory lending. Read the fine print. That's what I do. By the time you pay off the loan, your interest rates are going to be as high as 40%. Not only that, they put a lien against your home and they can dictate how you use your property. Like, for example, not allowing you to rent your home or build an ADU. So I like to look at both sides of things. Okay, so what is the mission statement of what these banks are offering? I like to give them their due, of course. So a handful of companies are offering homeowners cash in exchange for a stake of their home. The bank's going to own your home. You're a renter. The next frontier, making, similar investments to buyers who need help with a down payment. That's what we're dealing with. We'll give you the money for the down payment too. Companies are facing significant obstacles, though, to bringing this product to the mainstream, but some companies are, folks. Money talks, right? Money talks, and don't be surprised if companies start offering this product in their portfolio. Companies backed by some of the world's biggest investors are, they're doling out tens of thousands of dollars in cash to homeowners in exchange for a stake in their homes. Interest rates go up, let's get creative. Let's get more money and suck them dry. These types of deals aren't, they're not widely available for first-time buyers who haven't built up enough equity, however. But, the housing market today, they see it. There's a lot of equity. People have a lot of equity this time around and there's a lot of mostly younger buyers who must, contend with this inflation right now, stubbornly high, home prices and mortgage rates, and they're a little desperate. And, and then mortgage rates have doubled over the past year. So in this environment, coming up with enough money for a sizable down payment can downright seem impossible. And some people are desperate enough to get in the home to get a loan on the down payment. But some companies are getting ready to provide hunks of cash, and I'm telling you, they're beta testing it, they're doing it, and they don't mind giving up something in return. A piece of your future equity. I think it's a huge mistake, ladies and gentlemen. These deals, they're representing the next frontier for companies like who are doing this. Point, Unlock, and HomePace, which already offers so-called home equity investments to homeowners who are, rich on paper but don't want to pursue traditional debt options like home equity lines of credits to tap into that wealth. So I'm giving them their due here. So home equity investments deals took off earlier in the pandemic as skyrocketing home values pushed U.S. homeowners' equity to a record $29 trillion. So they were licking their chops. And that's from the Federal Reserve data. So Point, P-O-I-N-T, one of these companies, they're one of the largest of these companies, has originated nearly $1 billion worth of such deals since it was founded in 2015, with much of that volume coming in the past year, folks. In the past year, that's incredible. I'll get a mortgage conventional loan, and I'll take a loan on the down payment as well. So now these companies see an opportunity to snag even more market share by working with buyers who are desperately looking to increase their purchasing power in the face of mortgage rates that are hovering around 20-year highs. Let me just also say, if you're working with a competent real estate professional, they can do better than 7%. So, ladies and gentlemen, companies believe they can tackle the affordability crisis by fronting the money for down payments. So maybe some have the good intentions, but of course they want to make something on the back end, folks. Home equity investments only recently, they gained broad acceptance as a legitimate asset class after companies proved their viability, through years of successful returns. The margins are great, but they're there, and anywhere they can make a profit, especially right now with mortgage rates. So down payment products, whole new class of products, could follow a similar trajectory. Like as I mentioned earlier, for example, Point will offer investments up to 15% of the purchase price of a home with a maximum amount of $250K. Buyers typically are required to get a private mortgage insurance when they put down less than 20% of the purchase price for their home. Down payment investments could help them avoid those costs. But what are the costs on the down payment side of things, folks? So they could save some money on that end, hundreds of dollars a month, but what are they charging? So why is it so hard to make a down payment investment work? It's tricky. Down payment investments function in a similar way. A lump sum of cash today in exchange for a slice of equity in the future. What happens if that equity goes away, folks? A little bit, but they're more complicated since they also require coordination with the mortgage lender. You got that mortgage loan too. At least 2 real estate agents and the seller to make sure the home transition closes smoothly and on time. You're going to need competent real estate professionals to make this bad boy work. So Fannie Mae and Freddie Mac, the government-sponsored enterprises that purchase the vast majority of U.S. mortgages, they won't buy loans made to buyers that use such an equity investment. But folks, reading the fine print of them, at least for now, they're looking into it and they're considering it from people that I've talked to because their profits down a little bit. So, so a whole new asset class, a down payment market. Some buyers are willing to go that route of qualified mortgages. So these have higher rates. Combine all these factors, and it's not hard to see why down payment investments haven't caught on. Mainly despite the fact that the home equity investment companies have been around, which was surprising to me since the mid-2000s. One of the trailblazers, Unison, stopped offering down payment investments earlier in the pandemic, choosing instead to focus on traditional home equity agreements because of the complexity of it, and the margins weren't as high as they wanted. So, Very worrisome. You know, I looked at some interviews, executives requesting anonymity. You know, they said they're very dangerous for the buyer, and companies haven't rushed to market because of the risk position of it. And it's a very difficult product for the banks too to get a decent margin on as well. So, you know, the bottom line is this: since the mid 1970s, and I've done a lot of research on this, two corporations, Vanguard and BlackRock, and I've done a lot of videos on this. You know, they have gobbled up most companies in the world, effectively destroying the competitive market on which America's strength has rested, right? Leaving only false appearances behind. So, for example, while there are more than, let's say, 3,000 shareholders in Pepsi-Cola, Vanguard and BlackRock's holding account for nearly 1/3 of all shares. Of the top 10 shareholders in Pepsi-Cola, the top three, Vanguard, BlackRock, and State Street Corporation, own more shares than the remaining 7. Look what BlackRock's doing in the housing market. And that's just one company, ladies and gentlemen. Those two hedge funds own a majority stake in every Fortune 500 corporation. They own your butt. So anyone stupid enough to fall for that deserves to lose their house in 6 months when the bottom drops out of your house isn't worth half as much as you owe. You know, it's just a high risk position. Banks are not your friends, ladies and gentlemen. I have friends and good people that work at banks. You know, banks are not charity. If they are offering you something in exchange, they think 10 times that. They're there to make a profit. Don't ever trust any financial institution. They want you to be their forever paid interest slave, folks. Okay? And that there's other, you know, I get it. Hey, I work with bankers. I love bankers, and the good people work at banks. I'm just saying, they're there to make money. I'm trying to make money, and they're trying to make money. And you got to find a balance. But this is a high-risk product, folks. And when you look at the subprime crisis, when you see this type of creative lending, because rates have gone up, mortgage banks and lenders are strapped. There's a lot of change going on right now. And what creative ways can we do to make money with interest rates, because there's not as many first-time buyers in the market? And I just suggest to you, talk to your independent financial advisor, talk to your real estate professional, and make sure you read the fine print. Are those rates going to balloon? What is the interest rate on that? You're going to have your mortgage on the conventional. You're not going to own anything in your house. When you do have a mortgage, depending on how high it is, I mean, you are technically renting. Yes, you get the write-offs, which I think is wonderful. That's why I believe in homeownership. But if the bank owns the majority of your house and you have no equity position, you're just a renter. And you're paying property taxes and insurance and all those other good things. So I think it's a high-risk position. I appreciate the creativity that banks are doing, but I think it's a very risky thing. And when we looked at the subprime mess, and I followed that very closely after it happened, especially, and I just kind of see the writing on the wall, what's going on. Things like this just give me pause and worry me, and make sure you do your research on this and talk to your real estate attorney, talk to your financial advisor, talk to your real estate advisor and get their opinion on this, because I think it's a very risky move. I'm not saying in certain cases it could work. It could work. But in certain situations, and I can talk about that at a later date. Take care. Top line review. Be careful. Ciao.